Welcome to FinTech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. Bitcoin hit $124,000 on the 13th of August. Wyoming state-backed coin. SoFi's joined the Lightning Network. Circle's got a layer 1.
Sometimes these are effects of things that don't appear to be related, but when you look a little bit deeper, there are causes and effects in different parts of the market.
There were so many investments through the month of August. The investors are really opening up the checkbook. We're talking 10, 20, 60, 80 million dollars in these early rounds.
I personally am excited about an increased hash rate here in the US supporting the Bitcoin network.
US miners control over 31.5% of the global hash rate. We're seeing the first major political battle over crypto's future. Traditional banking is also mounting a coordinated assault on the recently passed Genius Act. It's important to understand that this isn't digital currency versus traditional banks. It's about who controls the future of finance.
It's about the evolution of money.
You're building a fintech product. You want to offer digital assets, but wallets? That's the hard part. Security, compliance, key orchestration, blockchain integration. That's why fintechs, payment platforms, and custodians choose Dfns. They provide wallets as a service that's API first, multi-chain by design, and secured within PC. No single point of failure. So you can launch across over 50 blockchains, automate policy controls, and stay audit ready without managing private keys. Stripe's Bridge powers crypto payments through Dfns. MoonPay scales wallets securely with Dfns. Sphere grew without compromising on control or compliance. Even major FIs like Fidelity, ABN AMRO, as well as custodians like Zodia and Tungsten trust Dfns to power their on-chain infrastructure. Developer ready, compliance approved, production grade from day one. If you're building in payments, exchanges, OTC desks, market makers, or DeFi, Dfns wallets work the way you need them to. Request your demo at fintechconfidential.com/DFNS. Dfns, secure wallets built right. Welcome to Web3 with FTC. If you're asking how blockchain, crypto, AI, or even quantum computing fits into your business strategy, this is built for you. We talk with the builders, decision makers who are doing the work. You'll hear smart conversations, straight insights, and no filler. Whether you're a founder, executive, or just trying to stay ahead, this is where real talk meets real tech. And powered by FinTech Confidential, we keep it practical. We cover the shifts that matter, and you'll get the signal, not the noise. So let's go ahead and get started. I'm your host, Tedd Huff, CEO of the fintech advisory firm Voliere. I'm here today with my confidential informant, Robert Musiala, a partner at Baker Hostetler, and he leads their Web3 practice along with the blog, The Blockchain Monitor, again for another month to recap what has been happening in Web3. And if you haven't already, you need to go check it out at www.theblockchainmonitor.com.
Always a pleasure, Ted. Thanks for having me.
We're unpacking what happened in August 2025 for Web3 and what this means for your business strategy. We're witnessing this maturation of this entire asset class that we know as digital assets. The bellwether seems to always be Bitcoin. And it didn't just hit new highs, it actually entered a completely uncharted territory where traditional price discovery models that you would use to figure out whether to buy or sell or to hold, really, they don't apply anymore. And the institutional infrastructure that is catching up to the technology's potential. Not only that, but U.S. mining operations are consolidating a lot of domestic control, while regulated investment products are absorbing a lot of the capital flows that we haven't seen before. But the real story is in the regulatory arena, and we're seeing the first major political battle over crypto's future. And traditional banking is also mounting a coordinated assault on the recently passed Genius Act. Now, trying to get the provisions pulled out that would let crypto platforms compete directly with conventional financial services And while all that's going on, the SEC has completely reversed course, launching a Project Crypto to provide regulatory clarity instead of enforcement actions. The infrastructure revolution isn't stopping. It keeps going. We've seen the first US bank integrate Bitcoin rails using a Lightning Network, state governments launching their own digital currencies and stablecoins, and purpose-built blockchain networks designed specifically for enterprise financial applications. Now, I know we've just been talking about the US here, but it's global. We've got Hong Kong positioned itself as Asia's crypto hub with stricter but clearer rules, while Europe's unified approach is fragmenting as companies compete for crypto business through implementation speed. And this is a technology, so there is a bunch of breakthroughs that are going on that are really leaning towards a real-time crime response network to combat illicit activity. Ethereum's latest upgrade shows innovation's double-edged sword. For speed and flexibility and understanding, open up some security vulnerabilities. So we're exploring how these shifts reshape the competitive landscape, what the banking industry's political pushback means for regulatory stability, and whether state versus federal tensions could reach the Supreme Court. Rob, let's start with the market developments, because what we're seeing isn't just about price appreciation. It's about the institutional infrastructure that makes sustained adoption possible.
That's right. I agree with that, Ted. This month, we saw Bitcoin hit an all-time high, but sometimes these are effects of things that don't appear to be related, but when you look a little bit deeper, there are causes and effects in different parts of the market. I am not an expert on the price. My expertise is on the legal and regulatory environment, focusing in on the legal and regulatory developments that sometimes affect the price. With the Genius Act passing, it to me seems like it could have been an effect or a cause of Bitcoin reaching a new all-time high in the month of August. The Genius Act passing is just the first step. We now have a period of regulations being published by the Office of the Comptroller of the Currency, the Department of the Treasury, and other federal banking regulators. It will be a notice and comment period where the public will have an opportunity to comment on those regulations that implement the act. And so it will be interesting to see how the process progresses. Is it a smooth process? Are there a lot of bumps in the road or large issues that appear that linger throughout that process? And it may be that the way that process plays out in the same way that passage of the Genius Act may have indirectly affected the price of Bitcoin and other digital assets. And that's a process that will play out over the next 6 to 12 months. A similar process will be happening in the EU with MiCA regulations and attempts to bring a similar regulatory regime over stablecoins in Europe. In the APAC region, Hong Kong and Singapore in particular are also taking steps to regulate stablecoins. Some of that activity will likely have downstream effects on the price of digital assets as institutions become more or less confident watching that regulatory activity play out.
We've hinted towards it, but Bitcoin hit $124,000 on the 13th of August. And as you look at that, it's pretty big, but there's so much more that was going on during the month. We saw over 54,000 BTC that was acquired through institutional investment. We see projections from some institutions and from some folks saying that it's going to reach 2 trillion by 2028. It's crazy seeing that stuff. But at the same time, we're seeing a lot of really firsts come out. So we've got SoFi that I mentioned earlier in the intro. Like, they're the first US bank that created the Lightning Network to really become the first financial institution to use that. Not only, but we also had Wyoming launch the first state-issued stablecoin, and how it's looking to be used is really interesting. And as you'd mentioned in previous episodes, there are some restrictions behind that, but it could really benefit a lot of these states that are doing this. And then looking at this, there were so many investments through the month of August also in this space. It felt like every day there were 2 or 3 more announcements of investments going into this. And really the investors are really opening up their checkbook. It's not like it's $1 million here, $2 million there. We're talking 10, 20, 60, $80 million that are getting in these early rounds, which has been crazy. But one of the things that I'm going to go back to Bitcoin, because one of the things that I found was interesting is I was trying to understand what was going on, but the available Bitcoin to be mined continues to go down. What's really remarkable is that US miners control over 31.5% of the global hash rate. And that's a record high. It's interesting for me when you look at the institutional investors, because their funding on the miners continues to increase. I think in August, it was somewhere around 9-ish%, which is the highest since February of this year. So it just continues to come through, with Bitcoin breaking through that $124,000 barrier and it being the major digital asset. How do you really assess the impacts of the administration's crypto-friendly policies, the regulatory pieces we have? We've got seasonal profit taking going on. Like, I'm trying to understand, like, what does it mean for the strategies around the institutional adoption and the mining infrastructures?
From a regulatory standpoint, the market is watching is the continued guidance that is issued by the SEC and the DOJ, which tends to be along the same path that it's been all year, very crypto-friendly guidance. And so that's a good thing as institutional money watches the market. We're seeing some profit taking right now. Is that profit taking counterbalanced by the parallel trend of Bitcoin treasury companies and public companies that are now exploring Bitcoin treasuries? It'll be interesting to see between those two trends, which one has more of an effect on the price in the Bitcoin market. Another thing that I was thinking about as you were talking about the Bitcoin market is, as you may recall, closer to the beginning of the year, there was an executive order for a strategic Bitcoin reserve. We haven't heard much about that lately. I don't think we will hear too much about it anytime soon in the next couple months. But it's almost what will not happen that may have an effect on the price. And that is that government agencies that have seized Bitcoin in enforcement actions, what they're likely not going to do is sell or offload that Bitcoin. Guys, has been the practice up until the recent executive order. The absence of that type of action, which was an ongoing occurrence in years past, and it likely is not going to happen this year, is probably one of the missed aspects of all this that may be applying upward pressure on the Bitcoin price, or the lack of downward pressure.
You bring that up because I was thinking about that as I was preparing for this recording. You mentioned the Bitcoin reserve. A bunch of states were like, we're going to do it, and a handful did. But then the idea is that it slowed down the sell rate so dramatically, which I think has really been one of the things that's kept the price up. They would seize it and immediately liquidate it and then put that into the cash reserves of the state or federal government. And so we were seeing a lot more sales, which meant that the availability of BTC was higher than it is today.
Another comment I'll make on the hash rate, which I think is very interesting. I personally am excited about an increased hash rate here in the US supporting the Bitcoin network. To me, that is a sign of maturity of the network, because you've got US-based miners that have both a vested interest in the Bitcoin network and also a vested interest in the US and the US economy. For someone like me whose practice is focused on the US, I'm always happy to see an increased hash rate in the US. And it reminds me of 2017, the very first fork, when Bitcoin forked into Bitcoin Cash. Not too long before that event, the hash rate, if you had collected all of the miners that were operating out of China for a short period of time, if they were all combined, would have combined to total over 51% of the hash rate. There was this small blip in time just before the split into Bitcoin Cash when the 51% attack became a remote reality that it could potentially happen. And so since then, with the fork to Bitcoin Cash and then all the events since then, that has not been a real threat. The more we see a strong hash rate in the US, the less of a threat something like the 51% attack becomes on the Bitcoin network. And that is also a positive sign for institutional adoption.
I think other positive signs for institutional adoption is SoFi becoming the first bank in the US to integrate Bitcoin Lightning Network. They're doing it for international remittances, targeting the $740.5 billion global market, and starting with Mexico. This is actually pretty big for them. It's using the Lightspark's universal money address system, so they can get that real 24/7 real-time USD to BTC conversion and settlement over to those in Mexico. When you look at that specific thing from a regulatory and compliance perspective, what are some of the implications when a federally regulated bank directly implements the Bitcoin payment rails for mainstream banking services? What precedent does this set for other financial institutions, and how might banking regulators respond to ensure customer protection while enabling cross-border payments?
This development is, to me, the most exciting and untalked about, a real bank implementing the Bitcoin Lightning Network. This kicks us back to the Bitcoin Cash forking incident in 2017. During that time, one of the reasons for the fork was that the mining community was trying to solve the problem of transaction fees. And at that time, transaction fees were getting too high, and the network, everyone supporting the network agreed on that, but they disagreed on a way to solve that problem. One reason for the fork were two different camps of how to try to solve the transaction fee problem. Each camp implemented a different solution. Around that time, the Lightning Network started to go into development, and now we see the Lightning Network in an initial mature phase where it can be implemented in real time. It's still maturing and evolving very quickly. But the Lightning Network fundamentally was intended to be a long-term solution to the transaction fee issue. You had startups like Spark developing Bitcoin Lightning solutions for a long time. We still haven't seen much mainstream adoption of the Lightning Network. To see a federally chartered bank implement Lightning in a small, limited way is really exciting. It shows that you've got a serious financial institution with US-based charter that has decided they're going to take that step and actually implement this emerging solution to remittances, transaction fees, and the Bitcoin network's transaction fees. This is also similar in some respects to what we talked about with respect to the strategic Bitcoin reserve having an after effect several months down the line with the absence of US Marshall sales of Bitcoin. This is a similar incident where we're seeing kind of a 6-month later effect. Back in March and April, the OCC and other federal banking regulators rescinded their notice of written non-objection policy, which at the time meant there was a policy in place that said if a bank is going to engage in crypto activities, they have to receive written notice of non-objection by their functional banking regulator. And that policy was rescinded, where the banking regulators essentially said, we're going to let banks go ahead and experiment with crypto on their own. They don't need written notice of non-objection. They don't need to disclose. Instead, we're going to review what they're doing as part of the normal supervisory process. And so here now, 6 months later, we see SoFi taking advantage of this and actually implementing a major product leveraging the Lightning Network in a way that normally would have been subject to this written notice of non-objection policy, but now they can do this. And yes, it will be subject to supervisory review when the bank gets reviewed on all sorts of things. And it'll be interesting if findings from that review are made public and if the banking regulators see anything there that creates undue risks. But for the time being, they will be allowed to deploy this solution. And that is really exciting. And again, it's this sort of 6-month after effect coming out of a change in the regulatory environment.
On a previous episode of Web3 with FTC, I sat down with Graham, the founder of Voltage, and we were talking about how he was seeing an upswelling of corporates leveraging the Lightning Network, move money within organizations and as well as and to and from other areas of their business. And so it's fun to see that groundswell on that piece of it is starting to flow into the traditional financial side of the house. And that definitely has some people concerned, and we'll touch on that in a little bit. But the thing that we talked about last month, and I want to just kind of keep it going because stablecoins momentum just continues to grow there. We're seeing estimates of how big the market is. The most conservative estimate is about 500 billion. The most optimistic is 2 trillion, predicting that by 2028. It's a big wide swath. But at the same time, as I mentioned earlier, we've got Wyoming, which just launched the FRNT coin, which is a stable coin issued out of Wyoming by the state of Wyoming. And right now, it looks like it's deployed across about 7 total blockchains as of when I was looking this up. And really just they're managing the collateral around that really, really well. Given your related things like GenieStack happens, it sets up Wyoming to do this. There's been some pushback from banking associations where they're really pushing to prohibit crypto exchanges from offering stablecoin yields. What are the fundamental legal challenges major companies face navigating stablecoin issuance?
The bank letter is interesting, and to me, it signals that paying interest or rewards on a stablecoin is very quickly becoming the most important issue to industry, both crypto industry and traditional financial industry.
Rob, do you think that's just a response to, hey, in my fiat, I get paid interest for holding it. I should get the same for the stable? Is that where you think that's being driven from, or something different driven off of the digital asset history?
That's part of it. Stablecoins, as you know, have been around in the US market for some time. Some stablecoins have paid rewards on holdings, but those rewards have not traditionally been paid by the stablecoin issuer. Instead, they have been paid by the exchange custodying those stablecoins on behalf of the retail user. The language of the GenieStack was consistent with that model and provides language essentially prohibiting the issuer of a stablecoin from paying interest to retail holders. But it's silent on the question of, can an exchange pay, we'll call it rewards, that's what the industry calls it, on stablecoins that it's holding on behalf of its retail customers. And the fact that the act is silent would mean technically under the plain language of the act that would be allowed. We are, by the way, going to go through a regulatory comment period. I'd expect proposed regulations, public comment on interim and final versions of those regulations, see this issue play out and get more clarity. But for the time being, the plain language of the act allows exchange to pay interest. Banks are unhappy with that. According to the letter submitted by the banks, believe that, or at least those banks that signed on to this, would incentivize, quote, a shift from bank deposits and money market funds to stablecoins. Instead of keeping your money in your bank account and earning interest from your bank, you're going to keep your money in stablecoin and earn rewards from an exchange. And the banks believe that has a risk of resulting in deposit flight. So deposits moving from banks into stablecoins. Of course, the exchange industry probably likes this concept.
Why do you think they're using the term rewards, not yield, like you would see in traditional banking?
Potentially to distinguish it from the interest paid on a bank account. It also could just be the language that the market is used to and has been using in the digital asset space. It's hard to say exactly, but this will be treated like interest, in my view. The banks cite a concern that this potential flight risk could create a credit supply crunch and higher interest rates. And so that's what the banks fundamentally are concerned about, is that if capital leaves a bank account and now is in stablecoins, banks have less capital. That creates a credit supply crunch and could result in higher interest rates and other downstream negative effects on the economy. I am not an economist, not in position to answer that question.
Neither am I.
That's how real that concern is, but that concern is going to play itself out in the regulation and comment process. It will be interesting to see if one or more banks get together to comment on this particular issue as the regulation process plays out for the Genius Act.
How should we be looking at the current lobbying efforts to reshape the Genius Act? Do you think there could be any constitutional issues that could arise from states like Wyoming issuing their stablecoin with any of the financial monetary authorities or the regulators?
That's another issue that I think will play itself out as regulations are published and finalized. Wyoming appears to be in a good position launching its stablecoin to meet the requirements of the Genius Act. So it does not look like the state of Wyoming is looking to go outside the boundaries of the act. Instead, they will likely stay within the boundaries of the act. And by the way, one of those important boundaries is the $10 billion limitation on market cap for a stablecoin issued under a state-based regulatory regime. So that will be one of the key limitations to keep an eye on in terms of getting a sense of what the intentions are behind the Wyoming stablecoin.
I'm really curious to what they're going to do when they start bumping up against that threshold. Like, how are they going to handle it? What are they going to do? Is it a forced liquidation? What are the tools and what are the safeguards that they're going to put in place so that they don't pass that? I haven't seen anything specific on how they're going to safeguard against it. So I'm super curious if you've seen anything.
I haven't seen anything yet, although theoretically the blockchain had the answer to this question. You can see the blockchain data and identify exactly how many FRNT tokens have been issued. I haven't confirmed this, but my suspicion is the state of Wyoming has the ability to burn those tokens and take them out of circulation. If they do bump up against that $10 billion threshold, that'll be a good problem for them to have. It'll be interesting to see how they respond. If there's demand to go above 10 billion, they would switch to being regulated by federal regulators. And so the stablecoin can go past 10 billion, but now you're subject to the federal regulatory regime, not the state. So that would be the decision point for any stablecoin that's issued under a state-based regime. In terms of a challenge to the constitutionality of something like the FRNT token, if there's a serious challenge, we'll see a preview of that in the notice and comment period for the regulations issued under Genius. If the party seriously wants to bring this type of challenge, they'll comment during the comment period. Even if that occurs, it's a long time from the comment to the act's implementation. And then from there, if there's an actual lawsuit, for a lawsuit to be filed and make its way all the way up to an appellate court or the Supreme Court, which could take years. As we both know, Ted, this industry and this technology moves lightning fast. There's no telling where the stablecoin technology and stablecoin market will be. And so it could be an instance of any serious challenges simply too little too late from a market perspective.
A perfect example of the market moving super fast, and this one actually surprised me a little bit, is the fact that Circle introduced ARC as a layer one specifically for financial institutions to leverage USDC to be the native gas for those denominated fees. So that was really surprising to me, but there are other companies that have also started building out their own layer ones, which just blows my mind that we've got more layer ones designed to support the types of things that they're doing. But not only that, I'm thinking about some other things that have been really interesting. And I know I'm blending things together here, but I think about some of the stuff that we talked about last month where we had stablecoin issuers applying to become a financial institution. We also had Paxos in August filed to convert its trust charter into a national OCC charter. They decided that they wanted to join the race with Circle and Ripple getting these charters. How are you seeing these, I guess you would call them enterprise-focused blockchain developments, the native infrastructures, the federal oversight of the banking Paxos looking for a banking charter. All of these US companies seem to be positioning themselves as an alternative to the traditional banking rails. But what would you say are some of the regulatory advantages of federal versus state level when looking at these types of adoption decisions?
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how.
The development of Paxos now being the third stablecoin issuer seeking an OCC bank charter is really interesting to me. It's not necessarily surprising because we're in a market economy and the digital asset industry has always, from day one, been viewed as an alternative to the traditional financial system. And while it does enter some spaces where the traditional financial system wasn't really relevant or being used, it also crosses over quite a bit. And there is quite a bit of crossover. And so with digital assets, there is a little bit of a fight, and always has been a fight, between crypto native companies and traditional financial services companies in terms of who is going to control that market share that has been opened up by digital assets. It's not surprising to see established stablecoin companies, with the Genius Act being passed, saying, not only are we going to be a stablecoin issuer under the Genius Act, but we want to do all the things a bank can do under the act related to stablecoins. And so we want to be our own bank instead of having a partner with another established bank. And that is just I think, example of logical activity in a free market. You don't want to rely on someone else or a competitor for your infrastructure. It's better to own your own infrastructure. But to the point you made earlier with regard to new layer one blockchains, it will be interesting to see how far that concept can go before there is a natural barrier based on the reasons for blockchain technology in the first place. In other words, things like decentralization. If we live in this world of just thousands of layer one blockchains, and if those blockchains are not sufficiently decentralized or are controlled by one or a handful of parties, not looking at a world that is simply the same as Web 2, where it's centralized database control at the end of the day, right? And it will be interesting, but at the same time, in a free market economy with actors making rational decisions, it makes sense for this concept to be explored as to whether there is room for more layer ones. But it will be interesting to see if those layer ones a year from now, 2 years from now, take off, or if they are left behind in favor of other more established blockchains like the Ethereum network and other similar networks that are more decentralized and bring those benefits.
One of the things I've noticed that there are a lot more discussions around the bridges between all of these different layer one chains. How do we provide an easy way to go from one chain to the next chain and not lose any of the fidelity of the data? And I think that's going to be a place where you're going to see a lot more activity over the course of the next 12 to 24 months. We're going to see a lot of folks come to market. I don't think we're going to see nearly as, and then it's the traditional thing, right? Where you have a whole bunch of people come to the market and maybe 20% of it makes it. But I think we're going to learn a lot in that as well on what works to go cross-chain at these types of volumes, at these levels, especially as we're looking at all these stables There are hundreds of stable coins, maybe thousands. I have to look at my last thing, but there are a large number of stables and they're on different chains. So I think that's going to be a big piece that starts to come into play on that one too.
As part of that, I will be interested to see if EVM compatible blockchains solidify their dominance as a preferred protocol for launching the layer one chain, so that there's some level of confidence that your digital assets will be able to be seamlessly or relatively seamlessly transferred between and among different EVM compatible chains. A different protocol method begins to emerge in opposition to EVM compatible. I would guess probably not, but it's possible and really interesting to see.
So we've been blending this topic into everything we've talked about today, but I want to get like super focused in on some of the regulatory updates. I know we sprinkle a little bit here and a little bit there, but let's go straight into this because as we've talked so far today, the regulatory landscape is starting to get a little frothy from externals, whether it be traditional banks that are mounting their coordinated lobbying campaign. You've got SEC, as I mentioned in the intro, their Project Crypto initiative, really trying to change how we think about digital asset regulation. Then we've got the regulatory guidance that's emerging on liquid staking and really putting some research around AI-powered compliance technologies. There's a lot of stuff going on, but I want to touch on first the American Bankers Association. Includes over 50 state banking associations. They launched a lobbying campaign announced on August 19th to revise the Genius Act. Their goal is to prohibit crypto exchanges from offering yield or rewards on stablecoin deposits, the state chartered issuers' ability to operate nationwide, which was my comment around Wyoming of when it hits that $10 billion, like what's going to actually happen. And so it's really just testing the waters to see how much of the traditional infrastructure can stay in play. And you'd mentioned just a bit ago, this interest / yield versus rewards being a distinction that's more a verbiage probably than anything. Can you break down why the Genius Act said the issuer can't pay rewards, but others can pay rewards, and what kind of implications does that have to the way we look at money movement and paying interest / yield on things?
What we don't know right now is the legislative intent behind the prohibition of interest on behalf of the issuer. We don't know. And obviously, we know that the intent was that the issuer shouldn't be paying interest on its stablecoins. But we don't know the broader intent as to whether interest on stablecoins was discussed and intended to be a blanket prohibition, or if there was some discussion of other parties, like an exchange, pay rewards on stablecoin holdings. Whether that issue was debated much as the Genius Act came to passage is an open question, but that issue is absolutely going to become front and center in issuing and finalizing regulations governing the act, potentially efforts to amend the act itself, not just the regulations interpreting the act. One way that I think about this is I've been thinking about this issue because, frankly, when I first analyzed the Genius Act, this was not something that to me was all that interesting. To me, it made sense that the issuer shouldn't pay interest. I hadn't thought much about exchanges paying rewards typically. I hadn't thought about how upset the traditional banking community would be about provision. But as I thought more, it occurred to me that a traditional financial institution like a bank likely views stablecoins as just a new payment method or a new network over which US dollars will be transferred. And so leading up to the passage of the Genius Act, it wouldn't surprise me if most traditional banks did not really see stablecoins as a threat to their business. The idea was that a stablecoin would be intended simply for the transfer of money and the store of value, which is
With that being said,
segregating those two parts of the Genius Act lend to that thinking, the idea that a charter bank in the U.S. has to be the custodian for the reserves, and a completely separate entity, on the other hand, is the actual stablecoin issuer that's managing the digital asset. As you said, and as I know and folks working in crypto know, stablecoins have always been used as a store of value. And in fact, in the crypto space, because it's safer to hold your value in stablecoin than it is in a volatile asset like Bitcoin, Ether, or another crypto. I wonder if there's this sort of fundamental disconnect there where when a banker hears stablecoin, they think this is just an advanced version of a payment app. Whereas on the other hand, when a crypto native hears stablecoin, they're thinking, this is where I want to store my value. And now we're seeing that disconnect come to a major area of disagreement over this provision of the act.
As you described, I wonder if maybe they had more insight, because by saying the issuer can't provide yield, does that not allow the financial institution to now provide the rewards and the yield that they on their traditional or asset sitting within the bank? I see it giving them the ability to do that if they so choose to. And so it's this piece where we don't, I'll just use ACH, right? So the Fed doesn't get yield on funds passed through their network. They don't get any of that, but the financial institution gets yield on the funds that are deposited that they're holding. And especially now with them not having to work with crypto, I see these two things of just giving them, hey, you guys can participate in this and you can continue to do what you've been doing just with this different medium than the traditional fiat. And that's how I was looking at it. But it took me a while to get there. It took me quite a while to get there to think about it from that perspective and really diving into what the association did and when they were going up against. When the American Bankers Association decided to contest the Genius Act, I'm wondering if they're doing that as a means to stall or to get some additional thoughts on it, and they haven't quite figured out how to benefit from issuing rewards and yield. Maybe because they're not ready to take custody. I'm not sure.
Interesting that you mentioned custody. It wouldn't surprise me if we end up seeing sort of two camps of the banks on this. One camp being the resistors who see stablecoins as a threat, and those that see an opportunity and are tech savvy enough to make a pivot and start to operate under some of these new rules that govern stablecoins as well as the larger crypto environment. And in particular, we had the federal banking regulators recently issue guidance on crypto asset safekeeping, which essentially gave banks a roadmap for what they would need to do to comply with their obligations and custody cryptocurrencies or digital assets on behalf of third parties. You take that guidance and then you also combine it with the fact that a bank can be a stablecoin issuer. They've got to set up a standalone entity to do that, or a subsidiary. The opportunities for banks to both issue their own stablecoins as well as to not only custody the reserves backing stablecoins, but also custody stablecoins themselves.
Mm-hmm.
Those could present opportunities that banks that are technology forward enough may see as an opportunity. And it may be that you end up with this triangle of the banks resisting, banks in favor of some of this stuff, but not all of it. And then the crypto natives that are at the tip of the triangle that have a little bit of a different agenda. And so we may have this sort of tug of war between those three camps in the market as it relates to stablecoins.
One of the things I do want to touch on, we've got the SEC working on the liquid staking that we talked about last month, but it seems like they're making some progress and really headed towards that. What do you see going on in that, and how are people reacting to that change?
This is a really sophisticated development, and it goes back to the
I was trying to keep it simple, but without diving in too deep.
No, but it's fascinating, and it's really encouraging to see a regulator get into this much detail in terms of an understanding of a very specific segment of the digital asset market. And as background, it goes back to the original statement from the SEC on certain protocol staking activities, where the SEC gave its opinion that certain activities related to proof of stake networks and node validators and ancillary activities related to operating a node validator would not trigger securities laws. As a supplement, the SEC has issued a very lengthy and detailed statement that specifically addresses liquid staking activities.
Aren't they calling them staking receipt tokens?
That's one of the terms that's in the guidance, and the guidance is full of defined terms, and it is very detailed. And so it really does require very careful interpretation. And it is absolutely not some kind of blanket, all liquid staking activities are okay. But what it does provide is a roadmap for how certain liquid staking activities can be conducted without fear of crossing into a securities law violation. And so that, just like the original staking protocol guidance did, provides confidence to the market actors that are specifically engaged in those very limited specific activities, that they can continue to build the business models that they've been building without fear of an SEC enforcement action. It gets very specific, and the exact activities that would fall within the guidance versus outside of it, that's a very facts and circumstances based. By giving that very detailed guidance, it does, I would argue, some confidence to those market actors that are engaged in those liquid staking activities, and also begins to legitimize liquid staking as a subset of protocol staking.
I want to move off of the US shores really quick. We talked about the fact that Hong Kong stablecoin framework, it took effect August 1st, and the requirements, including the 25 million Hong Kong dollar minimum capital requirements, 100% backing with high quality liquid assets. It's starting to create a market concentration where just a few issuers are going to be able to dominate, and really reducing the competition and maybe some of the innovation. So how do you see Hong Kong's limited licensing approach comparing to the Genius Act framework that we have here in the US?
I see the stablecoin market over the immediate term really playing out in 4 different pieces of the global stage. So we've got the Genius Act, which will govern US-based stablecoins and US-based stablecoin issuers. We've got the MiCA regulation in Europe, which will govern EU-based stablecoins and EU-based stablecoin issuers. There is a mechanism for issuers in those jurisdictions to interact following each jurisdiction's laws. And from the Genius Act perspective, generally speaking, the Genius Act says a foreign stablecoin issuer can issue its stablecoin in the US if it is operating under a foreign-based regime substantially similar to the Genius Act, and that determination is made by the Treasury Department. The one jurisdiction I see now that potentially fits that criteria would be the MiCA regulation. Mm-hmm. And so it may be that we eventually see some sort of parity between those two. Hong Kong seems to be the third that is emerging, that will likely be smaller in market cap, probably a little bit more focused, probably less issuers at play in that market. And it will be an emerging third regulated part of the globe that may eventually fit into this category of a foreign regime that is substantially similar to the US, where then a foreign-based stablecoin issuer operating under the Hong Kong regime may eventually be allowed into the US market. I think that would happen after MiCA issuers are allowed, but they could be the second foreign regime that meets the US criteria. And then outside of all that, we still have USDT as the largest digital asset market cap, even bigger than Bitcoin. That shows there is a demand for stablecoins, regulated or not regulated. And there's a massive demand, not just in the US, but in all areas of the globe. And so that's going to be, I think, in the immediate terms, the fourth dynamic in all this is jurisdictions that do not have stablecoin regulation, where the market is demanding stablecoins. Actors in those markets demand for both regulated stablecoins from the Genius Act perspective, as well as MiCA in Hong Kong and other jurisdictions. But where that demand is going to be competing with unregulated stablecoins or stablecoins that are not currently falling under any of those regimes, but that already have a large market cap.
As I was reading it, there are two camps. It's going to give Hong Kong an advantage because it's so strict and it'll require focus, and it's not going to allow the churn and all of the negative connotations with digital assets. On the other side, it's going to slow it down because it doesn't allow for continual innovation from smaller companies that want to do things that may not be fiscally advantageous. And I think it's been really interesting to see those two different things bounce back and forth off of that. You mentioned use MiCA, and I thought it was really, I'm seeing this with a number of folks that I'm working with now. You've got countries like Poland and Belgium wanting to delay allowing digital assets and stables to be ran through their countries. But then you've got Malta, Cyprus just racing to be like the forefront of this. So I guess where I'm going with that is, with that much fragmentation in the EU, what are the implications for European companies that are looking to leverage digital assets and stables in their day-to-day business?
My guess is that in the immediate term, businesses that realize that they need to begin implementing stablecoin payments for whatever reason are going to have really three options for doing this. And it will be a US-based stablecoin under the Genius Act, a MiCA-based stablecoin. And to your point, there are only a few, and it does seem to be a cumbersome process. But it could be one of those, back where it's a euro-based stablecoin. And then, like we were discussing earlier, there are businesses, especially in the startup world, that will simply use stablecoins that are in high demand, like a USDT or other stablecoins that are widely used, whether or not it's regulated in the European market, that will take that chance, similar to all the types of chances startups take as they work through trying to launch a business and stay competitive in their early stages. Those would be the three options in the immediate term in the European market. That may put pressure on the process that you described, where countries may feel pressure to be more permissive on allowing a regulated stablecoin under MiCA to operate within their jurisdiction, or to be more proactive about supporting MiCA regulated stablecoins.
You look at all these jurisdictions and different pieces of it, but that doesn't slow down the innovation of anything. Ethereum's latest upgrade has driven about 30% higher DeFi user activity through improved functionality like gas sponsorship and transaction batching. But as security firms are seeing, over 90% of the observed delegations are linked to malicious activity. And I think that's that double-edged sword, is that you get higher usage and faster speeds and more utilization of the network, but is it at the detriment of allowing more malicious activity? How do you balance legitimate user experience improvements that provide speed, but also protect against security vulnerabilities? And is this a pattern of something we should expect with future upgrades of other networks? And do you think there might be some legal frameworks that might emerge to really handle this delegation-based attack vectors?
But it's a fascinating concept. One of these examples of why I find this industry fascinating, because these things happen out of nowhere, and you were not expecting them. When you take a step back, you realize, oh, this was bound to happen. Unfortunately, throughout the history of emerging technology, criminals have almost always been early adopters of new technology, whether that's the internet, electronic money, whether cryptocurrencies or upgrades to a network like Ethereum. When the Ethereum network upgrades first came out, we talked about it. One of the more interesting upgrades was this ability to embed smart contract-like features into a wallet so that a wallet can now have some autonomy, just like a smart contract, and execute transactions automatically and become more programmatic. That was really exciting, but now we're seeing criminals take advantage of that functionality, being some of the first to take advantage of it. And it is really a lesson. This is a concept I was talking about the other day with some colleagues about how designers of smart contracts, or in this instance, designers of this upgrade that implemented smart contract-like features, really have to be well advised to think through the downstream effects of what their programming might be, not of the business model that they're developing, but to think about the broader developments that may occur on technology that they're releasing into the marketplace. This has been an issue time and time again in the digital asset space. The next iteration of that, as an attorney advising clients in this space, fortunately, we have had some pretty clear guidance from the SEC and the DOJ that enforcement actions focus on the actors using a protocol, not necessarily the developers. And that's a very important distinction. But there will also be a focus on knowledge and intent. That makes it important to really think through and document why you are programming certain functionality, what your intent is behind that, and to ensure that to the extent that you do have knowledge that something you as a developer have programmed is being used for illicit activity, that you're taking appropriate actions to not involve yourself in that activity and take other appropriate actions based on your particular facts and circumstances. This issue has come up time and time again. This is the most recent iteration of it. It's a cat and mouse game in emerging technology where companies have to come up with ways to defend against these new threats.
Rob, today we've covered how the market's transforming for the next phase of digital assets and money in general. We've got bankers lobbying against the Genius Act, which kind of reveals how much they're seeing digital assets and cryptocurrency threatening their traditional. Really, when you look at it, when over 50 state banks mobilize, it's clear that they're a little scared and they feel like they're at risk. But it's important to understand that this isn't digital currency versus traditional banks. It's about who controls the future of finance.
It's about the evolution of money.
Yeah, the evolution of money is a really big piece because, as we talked about, Wyoming state-backed coin, SoFi joined the Lightning Network, Circle's got a layer one. There's a lot of happening that are building infrastructure outside of the traditional rails. And like we mentioned, we're seeing a lot of enhancements that are happening, but we have to remember, just because the upgrades promise that it's going to make things better, there's always going to be an unforeseen risk that we didn't see that you need to be ready for. And so what I want everybody to take away from today is the fact that regulatory clarity continues to accelerate the adoption. Folks are looking at whether treasury or payments or assets, it's just going to continue to grow. The question I have for you is, are you ready? And what are you doing to stay ready? Rob, I appreciate you hopping on with me. We've been doing this a number of months, and every month it's so hard to squeeze in so many things that are going on. I wish we could hit more. What is one thing we didn't cover that you wanted to hit on today?
I would just underscore some of the things that we did think about. And in particular, to me, the Lightning Network is the biggest development because we rarely see such a big development for Lightning, and Lightning gets such little press. And I would keep my eye on Bitcoin Lightning and where that's going. And it'll be really interesting to see if other banks follow and implement Lightning-based solutions. And it will also be really interesting to see how the banks that do implement it fare when they are examined by the regulators. Hopefully, those examinations go well and Lightning will be able to continue to develop as, again, the next phase in the evolution of money.
Rob, thanks again. I agree with you. Looking at the Lightning Network and the financial institution using that, to me, was the biggest story of August. And we will continue to talk about the Genius Act because it's shaping the way that we look at digital assets in the US. There's going to be additional bills and policies and changes and regulatory items that continue to happen and evolve over this. I'm looking forward to sharing that with everybody. Well, folks, that does it for another episode of Web3 with FTC. If this discussion about Web3 got your attention today, well, that's great, because there's more where this came from. Go ahead and head over to YouTube, Spotify, Apple Podcasts, or wherever you listen, and hit the follow button. And if you want to stay plugged into everything we're doing and everything we're tracking here, go over to fintechconfidential.com and sign up. That's where all the deep dives live, as well as the future episodes. You'll be able to learn more. And be sure to share this with somebody who's serious about where fintech is going. And as always, keep moving forward.
As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords. They're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile